Why Kevin O'Leary holds dividend stocks during recession. O'Leary, who made his fortune by selling the learning company to Mattel for $3 billion during the dot-com boom, is also following in his mother's footsteps in providing for his family. O'Leary is committed to providing for his family's children's education through a family trust. But funding runs out at that point, leaving each to make their fortune, as he puts it. So, why does he hold dividend stocks during a recession? Make sure to watch till the end and subscribe for more videos. Here we begin. To ensure that the trust has enough resources to provide for future generations, O'Leary has long sought out investments that can deliver positive returns while posing less risk than the broader market. The glitzy worlds of hedge funds and private equity may have tempted O'Leary with his wealth. Still, he has largely stuck with dividend-paying stocks, inspiring his latest venture, the O-Shares family of ETFs that only invest in dividend payers. The difficult part came when deciding how to invest in those principles. While O'Leary liked ETFs, he discovered that the indexes they relied on were largely market cap weighted, which meant that most funds would have far too much money allocated to their largest components. O'Leary's large cap US fund, the O-Shares FTSE US Quality Dividend ETF, includes many well-known names, including Johnson & Johnson, ExxonMobil, and Apple. But the underlying index, developed in collaboration with FTSE Russell, also tests company cash flows to ensure dividends are sustainable. After all, dividends are among the first things to go when money is tight, according to O'Leary. He says that inflation is still high. For example, consumer prices in the United States rose 8.5% year-on-year in July, down from 9.1% in June, but still near a multi-decade high. The Fed has already raised interest rates several times this year in an attempt to slow that concerning trend. Because it is unclear how the economy will react to higher interest rates, stocks are selling off. However, investment mogul and Shark Tank star Kevin O'Leary believe that stocks should be held in a rising interest rate environment. Of course, not all stocks are created equal. During times of high inflation, Mr. Wonderful believes in these types of businesses. In light of current environment, O'Leary seeks companies that can raise prices without facing consumer backlash. Where you want to be in equities, especially when rates start to rise, O'Leary says, is in companies with pricing power. In other words, because their goods and services are necessities for people, they are willing to accept a small price increase, sometimes a larger one, as interest rates rise. But where would you look for businesses with bargaining power? Right now, healthcare looks good and cyclical consumer look really good, says O'Leary. He says that investors should focus on companies that produce items that people still need during times of inflation, particularly what they eat and what they drive. During periods of high inflation, O'Leary singles out the energy sector as a particularly prudent place to park some money. Fueling your car, heating your home, and cooking your food are all becoming more expensive. As a result, energy stocks have delivered outsized returns for several months. Despite the recent drop in oil prices, shares of ExxonMobil and ConocoPhillips are up roughly 71% and 92% respectively in the last year. Technology stocks, on the other hand, are underperforming. As a result, the Nasdaq, which is heavily weighted toward technology, is down about 22% year-to-date. O'Leary adds that high-priced tech stocks are under extra selling pressure as the Fed stands on loose money shifts. As interest rates rise, PE ratios fall and equity prices correct. So, you may ask, what are the top picks of O'Leary during a recession? Holding an ETF that tracks the S&P 500 has been a popular strategy for long-term investors. In today's environment, however, O'Leary does not believe in owning a broad-based benchmark index. Instead, his concerns are once again focused on inflation and the Fed. According to O'Leary, owning the ETF is a good inflation-fighting strategy because it contains companies that provide products and services that people require. It looks for companies with the highest quality balance sheets, companies that generate cash, companies with a high return on assets that distribute, he explains. Lockheed Martin Corporation, LMT, The world's largest defense company is Lockheed Martin Corporation. The U.S. Department of Defense accounts for roughly 60% of the company's revenue, with the remainder coming from other U.S. government agencies 10% and international clients 30%. In the first quarter of 2022, company-wide net sales fell to $14,964 million from $16,258 million, and diluted GAAP earnings per share fell to $6.44 from $6.56. Aeronautics net sales were flat at $6,401 million, up from $6,387 million the previous year, due to higher F-16 volumes offset by lower F-35 sales. United Health Group, UNH. In the United States, United Health Group is a diversified healthcare company. However, despite its massive revenues of more than $250 billion per year, United Health's net margins remain razor-thin, as is common in this industry. On July 15 of 2022, United Health reported second quarter earnings and the results were excellent, as was the updated guidance. Revenue increased by nearly 13% to $80.3 billion, exceeding estimates by more than $600 million. Next on the list, Johnson & Johnson, J&J. Johnson & Johnson is a multinational healthcare conglomerate. The business is currently divided into three divisions: consumer, pharmaceutical, and medical devices and diagnostics. In addition, the corporation has approximately 250 subsidiary companies operating in 60 countries and selling products in over 175 countries. During the fiscal year 2021, Johnson & Johnson had global sales of $93.8 billion. The company reported first quarter results for the fiscal year 2022 on April 19, 2022. Revenue increased by 5% to $23.4 billion, but fell short by $210 million. The adjusted earnings per share figure of $2.67 compared to $2.59 the previous year was $0.10 higher than expected. Apple, AAPL. With the introduction of the Macintosh in 1984, Apple revolutionized personal technology. Today, Apple designs, manufactures, and sells products such as iPhones, iPads, Macs, Apple Watch, and Apple TV. Apple also sells music, apps, and subscriptions through its services division. Apple's revenue for the quarter was $97.278 billion, an 8.6% increase over quarter 2 of 2021. Product sales increased 6.6%. with iPhones accounting for 5.5% of total sales. Apple is Berkshire Hathaway's largest holding, making it one of the best Warren Buffett stocks. Next on the list, McDonald's Corporation, MCD. McDonald's, headquartered in Chicago, Illinois, was founded in 1940 and is the world's leading global food service retailer, with nearly 40,000 locations in over 100 countries. Approximately 93% of the stores are owned and operated independently. McDonald's is a recession-proof company. In addition, its global scale, a massive network of restaurants, well-known brand, and real estate assets give it a competitive advantage. Indeed, the company's superior track record against numerous competitors has demonstrated why these factors are critical to its success. Microsoft Corporation, MSFT. Microsoft Corporation, headquartered in Redmond, Washington, was founded in 1975 and developed, manufactures, and sells software and hardware to businesses and consumers. Operating systems, business software, software development tools, video games and gaming hardware, and cloud services are among its products. Microsoft reported Q3 fiscal year 2022 results for the period ending March 31st of 2022 on April 26, 2022. The company generated $49.4 billion in revenue for the quarter, an 18% increase over quarter 3 of 2021. In addition, productivity and business processes, intelligent cloud, and personal computing all increased by 17%, 26%, and 11% respectively. And last on the list, but definitely not the least, Pfizer Incorporation, PFE. Pfizer Inc. is a multinational pharmaceutical corporation that specializes in prescription drugs and vaccines. It is a mega-cap stock with a market capitalization of $287 billion. Our complete list of mega-cap stocks can be found here. On May 3rd of 2022, Pfizer reported excellent Q1 2022 results. Revenue increased 77% year-on-year to $25,661 million from $14,516 million, and adjusted diluted earnings per share increased 72% to $1.62 from $0.95. In comparable quarters, diluted GAAP earnings per share increased 59% to $1.37 from $0.86. With the COVID-19 vaccine and antiviral drug, Pfizer enjoys market leadership. In the quarter, the company generated nearly $15 billion in revenue from these two products alone. In addition, Pfizer maintained its revenue guidance for 2022 at $98 billion to $102 billion while lowering adjusted diluted EPS to $6.25 to $6.45 billion. Let us know what you think about this video, your views in the comments below, and subscribe for more. This has been Dividend Bear, and I'll see you in the next video.